Hello and welcome to this special edition of Deal Makers. Now, the sentiment has changed in the financial world and the mood is a little upbeat. But when will all this translate into deal making? And to talk about that and the revival of the deal street, we have two experienced and ace deal makers with us, Ashok Wadhwa as well as Manish Chokhani, gentlemen who need no introduction. Gentlemen, so good to have you on the show. I will start with you, Manish. How has been the transition from the deal street? You were a deal maker all your life. I have known you like that for all these years. And now you are on the investment side. What is it that has changed as far as your perspective is concerned? And how are the foreigners really looking at India?
So, well, first of all, thanks for having me, Nisha. The answer to the first question is very easy. When you're trying to do deals, you're a hunter. When you're doing investments, you're a farmer. So I'm enjoying it tremendously. You take our time, build up companies well, invest and let the investment mature. So it's great. So I've really loved the transition. As far as how investors are looking at India from a TPG perspective, we'd love to do more investments in India. We think that's the kind of investments India needs because it's not just the equity money, but it's also the technology, the market access, the managerial acumen, the network of companies we can bring in. And if, say, the firm has about $60–70 billion of capital, we'd love to put at least 5% of that in India, if not more.
Right. Let me get in, Ashok, on this. Now, Ashok, you've done so many deals. You've been pretty much like a house banker to some of the promoters, I know, and some of the big deals have been cracked by your firm. Right now, even though the budget is behind us, the elections have given us a very good and a strong government at the center. Do you think that still there is something missing on the deal street because of which the lull still remains?
Well, deal street is open to do business at all points of time, regardless of the environment and regardless of the government. At any point of time, there are companies that are in stress that need help and that need to be acquired. And there are companies that are doing very well, which need to get consolidated. So deal street, as I said, is open for business at all times. There is nothing like shut the business. It's a business that works 24/7, 365 days in a year.
But you will also agree that while we were all talking about ease of doing business, there is something called ease of doing deals as well. And that is probably lacking?
I won't say that is lacking. I mean, do remember that regulatory interventions and ease of regulation is a great facilitator. Deal making starts in the minds of a promoter, but eventually it gets done or undone because of often regulatory environment. I mean, you now have, from a foreigner's perspective, FIPB, Competition Commission, tax issues to address because of Mauritius, sellers, buyers. So I would say that a more friendly regulatory environment certainly facilitates deal making, and a more difficult, regulatory environment is certainly an obstacle to deal making.
So, Manish, here, do you think after this budget and some bit of information that has come in on retrospective tax and how it's going to be handled henceforth, do you think it has given some comfort to the foreign investors? Has the mindset changed about India?
I think you'll have to see something happening on the ground. It's not just the budget, which is really a statement of intent, but one or two test cases going through and not facing the troubles that they did in the past. I think that will be critical because for investors, once you put the money in, it's almost like, you're inside and now how do you get out? So I don't think it's a turning point as yet, but surely the mood has changed towards India. The amount of interest is tremendous. And like I've said on various shows, that India is the only country which has moved right, while the rest of the world has been going left. So certainly the interest levels are tremendous and the opportunity is very large.
You did say that now you have become a farmer. Is the ground fertile enough in India now?
Aggregate profits of corporate sector of India, it's $100 billion. If you think of the interest payment of just the central government of India, it is $70 billion, which means the balance sheet of India Inc. is some $700–800 billion, and the balance sheet of the government of India is about $900 billion. They're clearly taking over the space for the private sector to come and thrive, and it will always be the foreigners who will have advantages. So all our tax laws actually are geared to attracting FII investment. FDI, as he rightly says, is difficult. You have to, go and get so many approvals. Whereas FDI is what you really want, domestic manufacturing is what you really want. I think there is work to be done there.
That's why I was harping on ease of doing deal making as well, because FII is quick money in and out, FDI will take a lot of effort. But Ashok, what are those key areas that can be worked upon so that deal making is easy? And do you agree that there is an intent but it's still getting stopped at some level?
So again, break it up into two parts, what the government can do and what the corporate sector and corporate India must do. What the government can do, as I said, is provide clarity, provide transparency, introduce consistent legislation, not have overlapping legislation such that, there's multiplicity of approvals that are required to gain, consummate any transaction. And it's not that other countries don't have rules and regulations. I mean, there is antitrust versus our competition commission. There is tax regulation everywhere else in the world. But we just make it so difficult through the process. There is so much inconsistency in dealing with two identical cases that there is absolutely no predictability. So I would say focus on predictability. You don't need to reduce the number of regulation, but focus on predictability, focus on ease, and make it more inviting for foreigners and direct investment to come to India. That's the long-term capital that will sit here and produce gains for many, many years. So that's what the government can do. What can corporate sector can do? I think corporate sector needs to become more pragmatic. Our owners are still very emotionally attached to the businesses that they have created. They need to kind of separate their emotions from the reality. If a business needs consolidation and that's where the gain is going to come, don't bother about whether you are the majority shareholder or somebody else is the majority shareholder. Can you think of a proposition where two companies owned by two Indian groups merge to form, a more viable business, because consolidation will deliver better value to both of them? Now, it's not that our Indian owners don't understand the importance of that consolidation and the value that is delivered through that consolidation. But I guess emotions and egos at points of time become a barrier to do even what is rationally right.
But if I am not wrong, all I have heard from all the big deal makers is that emotions and ego are the two most important ingredients for any deal making. But what about the shareholders? They deserve a better management if one management cannot take care of the company the way it should be. And if times change.
Well, but see the reality of India. If 75 companies are 75% of India's market cap, in the Nifty itself, if you just take the companies where FII ownership is allowed, we are pretty much at ownership of 80% of those free floats available. In company after company after company, even the FIIs cannot buy anymore. In my other hat, I would have expected India would attract $50 billion of FII money. Question is, what do they buy now? Because what they want to buy, the well-governed, more transparent companies, are already maxed out. And what you're left to buy are the companies where you're a bit fearful about what are the intentions of the promoter really over there. And that's the dilemma one faces constantly.
So what do you think about this situation where the promoters have now raised equity and they have dressed up their balance sheet well enough to sustain like this? So therefore, all the distressed sales we were talking about and that debt concerns or sitting on the books of many of these companies, and because of which they should shed some of the assets to recover funds, that is out of the picture now.
Not necessarily. But let me start with the good news. If this was true, if this proposition was true, it's good for our banking sector. Remember, we've been very worried about the stress in our banking sector because of large lending to so-called broken balance sheets. If these broken balance sheets are corrected again, then clearly the banking sector will be de-stressed. And for me, that's great news, because a vibrant, robust banking sector is extremely important for the development of this country, particularly as the more positive economic environment develops. The other point I'd like to make, a little departure from what Manish said, is that unlike in the past, where almost everybody could wash your sins in a bull environment, I see a little different environment this time around.
How so?
Investors this time around are being a wee bit more cautious, and only a wee bit more cautious, but that's a good beginning to a trend, where they're not actually supporting and providing capital to anybody and everybody. Within the broken balance sheets, they are now trying to evaluate broken balance sheets that have a potential or ability to correct themselves, because hey, listen, all promoters make mistakes. You don't punish a promoter because he made mistake. You punish a promoter if he did something deliberately wrong or in defiance of the protection of minority shareholders. Those are the type of promoters that FIIs are shy to invest with. And I see that pattern coming up this time around, that through these QIP raising, not everybody has been able to go out and take advantage of the bull environment. Many have, some have not, but the some those who have not maybe don't deserve to get that capital, and therefore those opportunities continue to prevail, those challenges continue to remain, and those assets should become available sooner rather than later. The only other point I'd like to add, going on from where Manish said, is that, we have a benign environment in terms of forcing companies into liquidation, and our bankruptcy rules are quite archaic.
Yes.
We do need to make them more current. If there's one regulation that needs to be developed and made more current, I would say the bankruptcy rule.
Chapter 11 is non-existent.
Yeah, and empowering banks and motivating banks, and for the banks, particularly public sector banks, taking definitive actions against those who are defaulters.
I am glad that you raised this point, because a lot of private investment bankers have this grudge against the PSU banks, which have doled out huge amount of funds for big companies and do not take action when the company is defaulting. And therefore, a KFA situation actually came into being, because probably action was not taken earlier in the day. So I hate to break this conversation flow, but we'll have to take a short breather here, and we'll come back and discuss more about sectors which are going to be vibrant on the deal scene and what else can be done to bring about ease of deal making in the Indian scenario. Stay tuned for this very interesting conversation.